Here is a number worth sitting with for a moment, and it comes from the Federal Reserve.
The median retirement savings for American families, not the bottom, but the exact middle, is $87,000. That figure comes from the Federal Reserve's own comprehensive survey of household finances, which is the most complete picture we have. While $87,000 sounds like a real amount of money, consider what it actually needs to do in retirement. Financial planners commonly estimate that a portfolio of $1 million might generate around $40,000 a year. That estimate uses a standard 4% withdrawal rate, which is a commonly used planning benchmark, not a guarantee. To generate $50,000 a year in retirement income, you would need roughly $1.25 million. The middle American household has saved about 7 cents on the dollar toward that kind of target. You might be thinking that this average includes younger people who are just getting started, and that is fair. So let's look at households approaching retirement age, meaning workers in their late 50s and early 60s. Even in that group, savings balances are still running well below the benchmarks most financial professionals use as a guide. Layered underneath all of that is a second problem that most people are quietly counting on to fix the gap. That second problem is a program that is itself running on a financial clock that most Americans do not know exists. This is a video about the retirement gap, not the one you think you know, but the real one. The one hiding behind assumptions that feel reasonable until you actually run the math on them. To understand why most Americans will run out of money before retirement, you have to start with how the system changed. For most of the 20th century, if you worked a full career at a stable employer, retirement looked predictable. The money came from a defined benefit pension, meaning your employer made promises, funded a plan, and carried the investment risk. You showed up for 30 years, and then the checks came for life, guaranteed and consistent. That system has largely been replaced by the 401k, a defined contribution plan with a very different set of rules. In a 401k plan, the employee decides whether to participate, how much to contribute, and how to invest. The employer might match some portion of contributions, but the saving decision and the investment risk belong to the individual worker. The risk of outliving the money is also transferred entirely to the individual, which is a significant structural change. That shift was not inherently bad, and for disciplined savers with good incomes and enough time, it can accumulate real wealth. The problem is that the system was designed for an idealized version of the American worker that many workers don't match. And the data has been quietly confirming this mismatch for years across multiple federal surveys and research institutions. Let's start with what the numbers actually show, because the picture is more fragmented than most people realize. The Federal Reserve Survey of Consumer Finances is the most comprehensive look at American household wealth that currently exists. In its most recent edition, covering 2022, it found that the median retirement savings across all families was $87,000. The average was substantially higher, but averages in wealth data are misleading because they get pulled upward by households at the top. The median tells you what a typical household actually has, and among households with any retirement savings, only about 9% have $500,000 or more. Here is the detail that tends to surprise people, and it is that roughly 46% of American households have no retirement account of any kind. Not a small 401k, not a Roth IRA, not anything at all saved in a dedicated retirement vehicle. And that is not entirely because people chose not to save, because a big piece of it is structural. According to the Pew Charitable Trusts, an estimated 56 million private sector workers do not have access to a workplace retirement plan. That is more than 1 in 3 private sector workers who simply do not have the opportunity to save through an employer. If you do not have a plan at work and you are earning a modest income, the odds of proactively opening an IRA are not high. Research on behavioral finance has consistently shown that when saving requires an active opt-in decision, participation rates drop dramatically compared to automatic enrollment. When saving is automatic, participation rises, and when it requires effort and initiative, most people delay or skip it entirely. Vanguard's most recent annual report on its own plan participants found that the average total contribution rate was 12% of income. That 12% figure combines both employee and employer dollars, and it sits right at the floor of the recommended range. Most financial professionals consider 12 to 15% the minimum contribution rate for an adequate retirement outcome over a full career, which means roughly half of even active savers are below that floor, and the broader workforce picture is considerably more stretched. So before you even factor in investment returns or Social Security, you have a system with a large structural participation problem. Here is where the math gets more uncomfortable, because the gap is not just about the money people have not saved. It is also about what they are counting on to fill the difference. And for most Americans, that answer is Social Security. Social Security is a genuinely important program, and the Federal Reserve's own survey data shows that 78% of retirees received it in 2024. Among retired adults, more than half describe themselves as very reliant on Social Security to cover their necessary living expenses. For lower-income households, that reliance is even higher, making Social Security not a supplement, but the actual retirement system for millions. And this is where something most people vaguely know about becomes a real financial planning variable, rather than a distant political abstraction. The Social Security Board of Trustees releases an annual report on the financial condition of the program's trust funds every year. The 2025 report, released in June of that year, projected that the Old Age and Survivors Insurance Trust Fund faces a depletion date. Under current law, and without congressional action, that trust fund is projected to exhaust its reserves in 2033. If that happens, and Congress takes no action before then, ongoing payroll tax revenue would cover approximately 77% of scheduled retirement benefits. To be precise about what that means, Social Security does not disappear because the program continues to collect payroll taxes and pay benefits. But under current law, if Congress does not act, the benefits that get paid out would be reduced from their scheduled levels. The Bipartisan Policy Center estimated that the trust fund's 2033 depletion would result in an across-the-board cut of roughly 23%. Take a moment to think about what that means for someone whose retirement plan assumes their full scheduled Social Security benefit. A household receiving $30,000 a year in Social Security income would receive closer to $23,000 under that scenario. That $7,000 annual gap compounds across a retirement that might last 20 or 25 years, which adds up significantly. And remember, this is the gap on the benefit side alone, stacking on top of whatever portfolio shortfall already exists. The Committee for a Responsible Federal Budget modeled what this could mean for a typical couple retiring around the time of insolvency. Their estimate suggested that couple could face a reduction of roughly $16,500 per year in Social Security income. That is a modeled estimate and not an official government projection, but it gives you a sense of the potential scale involved. The reason this is happening is demographics, and it is structural rather than political in its origin. In 1960, there were more than 5 workers paying Social Security payroll taxes for every single beneficiary receiving benefits. Today, that ratio is under 3 to 1, and the trustees project it will continue declining as the baby boom generation moves through retirement. The workforce behind that generation is growing more slowly, which means fewer workers supporting a growing number of beneficiaries over time. Now, let's put this all together in a way that actually lands, using a realistic, illustrative household as a reference point. Imagine a couple in their early 40s earning around $80,000 a year combined, which is a plausible median figure. They have some savings, maybe $60,000 in retirement accounts between them, and they have been contributing to their 401k. But they have been contributing inconsistently because life happened. There were job changes, and contributions dropped during a rough stretch. There were also some early withdrawals during a hard period, which is more common than most people realize. Vanguard's 2025 report found that 4.8% of plan participants took a hardship withdrawal in 2024, up from 3.6% the year before. More than a third of those hardship withdrawals were taken to avoid foreclosure or eviction, which tells you something real about household financial stress. This hypothetical couple is not unusual and not reckless. They are just navigating real life inside a system that does not forgive interruptions well. Now, if we assume this couple continues contributing at a moderate rate from their early 40s forward, the math looks like this. Let's say a combined 10% of income, including any employer match, with a return assumption of around 5% annually in real terms. That 5% figure is a conservative long-run estimate, used here as an illustrative assumption, and your actual results will vary. Under those assumptions, they might accumulate somewhere in the range of $500,000 to $600,000 by retirement at 65. Those are illustrative numbers, so let's call it $550,000 as a reasonable working figure for this scenario. At a 4% withdrawal rate, that portfolio generates about $22,000 a year in retirement income. Add their full Social Security benefit, let's say $28,000 annually for this household, and you get roughly $50,000 per year. That $50,000 represents around 62% of their pre-retirement income, landing near the lower boundary of standard income replacement targets. That scenario is actually not catastrophic, but it depends on several things going right simultaneously over a long period of time. It requires consistent contributions going forward, no more early withdrawals, investment returns holding near historical averages, and Social Security paying full scheduled benefits. If the trust fund issue goes unresolved and benefits are reduced by even 20%, that $28,000 drops to around $22,000. Combined retirement income then falls below $45,000, and the cushion that made the plan workable essentially disappears. And this is for a household that was doing reasonably well compared to what the median data actually shows. For the household sitting on $87,000 at age 55, with 10 years until a planned retirement, the math closes fast. Even under generous assumptions, 10 years of contributions and growth from a low base does not bridge a $1 million gap. The senior poverty rate in the United States rose to 15% in 2024, the highest rate among all age groups that year. That is not an accident. It is the downstream consequence of a retirement system that works well for some and creates real risk for others. Now, the honest version of this conversation has to include what this picture misses, because the retirement crisis narrative can be overstated. First, retirement account balances are not the whole picture, because home equity is a significant asset for millions of older Americans. Home equity is not captured in retirement account data, but for households who own their homes outright, it can provide a meaningful buffer. That buffer might come through downsizing, renting, or for those willing to consider it, a reverse mortgage on the property. If you factor home equity into the calculation, the retirement readiness picture looks somewhat less dire for home-owning households specifically. Second, Social Security has faced projected trust fund shortfalls before, and the last serious depletion crisis was in 1983. Congress addressed that 1983 situation through a bipartisan package of changes, and the program was adjusted rather than eliminated. Most analysts across the political spectrum expect some version of congressional intervention before 2033, though the exact form is genuinely uncertain. Complete inaction resulting in an across-the-board cut is a risk worth planning around, But it is not the only plausible outcome. Third, a meaningful segment of Americans is actually on track for retirement, particularly higher earners with consistent employment histories and good employer plans. The national averages are being pulled down substantially by households with nothing saved at all, and the distribution matters as much as the average. And finally, some retirees spend significantly less than 70 to 80% of their pre-retirement income because spending patterns shift in real ways. Housing costs often decline in retirement. Commuting disappears, and for some households, a lower replacement rate is genuinely comfortable and sufficient.
The retirement gap is real and well documented, but it is also not uniform, and knowing where you specifically fall in the distribution matters most.
Here is the thing that ties all of this together, and it is not really about savings rates or trust fund math at its core. The retirement system in the United States was quietly redesigned over 40 years to require individuals to make a long sequence of correct decisions. Save consistently, choose appropriate investments, avoid early withdrawals, adjust over time, and do not panic during market downturns. All over decades. That is a lot to ask, and behavioral science has been documenting for years that humans are not naturally wired for this kind of optimization. We respond to defaults, we anchor to round numbers, and we weight present sacrifice more heavily than future gain. The gap between what people intend to save and what they actually save is not a character flaw, but a predictable behavioral pattern. It is the consequence of asking people to manage a long-run optimization problem with no feedback loop and no real second chances. The most expensive decision most people make about retirement is not a bad fund choice or the wrong asset allocation. It is a delayed start or an interrupted one that never fully recovers because time is the one input you cannot replace in compounding. So the question worth asking yourself, not to create anxiety, but to create clarity, is a simple and specific one. If you had to describe your actual retirement plan in one paragraph, using real numbers, real accounts, and a real timeline, what would that paragraph say? Not the plan you intend to have someday, and not the vague sense that it'll probably work out somehow.
The actual plan with real numbers, because the gap between those two versions of the plan is exactly where the risk lives.
If you want to go deeper on how Social Security fits into this, specifically how to think about claiming age and spousal benefits, that is worth its own conversation.
It is one of the most decision-sensitive areas in all of personal finance, and most people are navigating it without a clear framework. If this kind of calm, evidence-based look at how money actually works is useful to you, staying close to this channel is an easy thing to do.